Hi, this is Jack from Alpha Charts with a educational video on chart setup. So I've been asked many times on how I set up my chart and why I use the things I do on my chart. So this video will attempt to answer all those questions and explain my process and my thought behind um, again how I construct the chart itself and what a chart represents to me. So before we get started, this video is for educational purposes only, and I may hold positions in the equities mentioned. We're going to be using Cloudflare as my example, and I currently do own shares of Cloudflare. Um, so again, this is for educational purposes only. You have to decide whether this is within your time frame and risk tolerance. Also, if you like me, please like and subscribe to my YouTube channel. It really does help me. And also on Twitter at AlphaCharts365. Okay, so the chart. So the way that I think about charts in general, big picture, is a chart is a visual representation of supply and demand, right? As well as of human emotion. And we call that fear and greed. So we have supply and demand and fear and greed. And that's what this chart represents to me. All right. And so the primary indicator on a chart is price, right? Price is the primary indicator. Um, at any given time, the price reflects all known information. Okay. So as of this closing right here, by the way, today is January 23rd, 2021. This is what the market thinks Cloudflare is worth with all known information. Okay. And so we're not in the predictive business here, but we do use past information to give us clues about potential future movements of price, right? And we're playing the odds here. Um, and because all information is known in price, I don't really look at any fundamental analysis at all. Now, in my scans that I run, I have my two scans that I run. On those, there are fundamental factors that go into there to help keep my universe keep my universe tight within where I want it. But I don't look at any kind of financial filings at all. Never have, and I wouldn't be doing this if I had to be honest with you. Um, as Brian Shannon on Twitter says, only price pays. So all information is known within this price bar, and only price pays, and that is our primary indicator. So talking about price, we have some choices in how we want to visualize price. Okay. So the first type represented here is the hollow candle. So a hollow candle, I'm going to switch to TrendSpider's website because they have a great blog post on hollow candles, and it kind of explains it really, really well. So there's four types of hollow candles here, right? And in every hollow candle, you have a high and a low, and you have an open and a close. So there are four possibilities. The first possibility is that the candle opened up higher and then sold off throughout the day, right? There was some wiggle to the upside after it opened up, then it came down, went down lower, and then it closed here. That is a filled in green body on this candle, okay? And that means that there was some selling, even though it closed higher than it opened still, there was selling pressure. Not my favorite candle in the world, but even though it was green. Now, this green hollow candle is one that I love to see, and the bigger the better, right? So it opened up down here, maybe it sold off a little bit the first, 15, 20 minutes, and then went all the way up here and maybe sold off a little bit right before the close, but closed much higher than it opened, right? So this gives me a green hollow candle, and this is a very bullish looking candle. Now on the downside, we have the red candles. So on the red candles, it opened up here, right? And then it sold off throughout the day and it got filled in and it closed lower than it opened. All right, so that's a green filled in candle. And the green red I'm sorry, the hollow red candle, actually I like to see those also because it opened lower, and then the buyers, came in and it closed higher than the open. That shows, at least to me, that there is some support for this particular position. And so I really like how these candles are. Now it's still closed down for the day on this candle, but I liked, because I think on a psychological point that the buyers stepped in. Same thing for this candle. This says the buyers stepped in. And so these are candle. I mean, I love this candle. That's up. That's okay, right? It's more of a, for me, indecision type candle. This is, closed down, constructive, and this is just a bad candle if you're bullish. So those are the Japanese candlesticks, which is the first type of candle. Um, Another way you can construct your chart is with open, high, low, close candles, and I'm going to show you those. All right, so here's a picture of open, high, low, close. So these are bars, and I don't really use these, but I've seen some people like Richard Moglen use these, and a few others use them on Twitter. So I just want to show them so you know. So your open is going to be the left side of the bar, right? The low obviously is down here, the high is up here, and the close will be on the right side. So if this bar is low and this bar is high, it was up on the day. And if this, and again, and if it was green, right? Now it could be red. I don't know why this is blue. If this is, if it's red, it open here and close down, it'll be red on the day. And so again, I don't really use these. I'm not an expert in these candles, but I just wanted to kind of let you guys know what the what these represent. Basically, again, not my thing. And if you look at it here, you could kind of side by side. This is a bullish candlestick, and this would be a bullish bar candle. This would be a bearish Japanese candle. This would be a bearish bar candle. Okay. The other thing that the other type of chart that I use sometimes will be a line chart. And sometimes I like to use the line charts because it takes out all the noise. We're not worried about openings. We're not worried about highs. All we care about is closing price, right? The last price of the day. And that's what line charts plot for us. And so as you see here, and then it filters out the noise. Sometimes if it's a really, I don't want to say messy chart, but if it's a little disorganized in the price movement, I'll use a line chart. Also, if it's if I'm using ratio charts, like sometimes you'll see me use I don't know, bond ratios or something, I'll be using a line chart for ratio charts, or if I want to see if net versus the SPX, what does that look like? I'll use a line chart for that. So I do use line charts in my charting, quite often actually. But Japanese candlesticks are my main chart, where I want to visualize my chart, because I understand them the best out of any of them. Do what works for you. There's many people that use the bar charts, and I've seen line charts. So do what works for you, but that's the way I want to visualize price for me. All right, so that is price, our primary indicator. So now let's go to some secondary indicators. And one secondary indicator is going to be volume. So I use volume on my charts. And what am I looking for? Or why am I looking for volume? So volume shows the power behind the movement in price. Okay. So if I'm looking for big volume, if I see big volume on a breakout, I know there's a lot of power behind that. I know there's a lot of power behind that move. So that's so we like that, right? We want to see power behind the move. And if we see a lot of power behind the move, that's not your Aunt Millie buying, right? That's Aunt Millie, not my Aunt Millie. But yeah, so what I'm saying, that's the big institutions buying. So that's what we want to look at. And you can see here, we want to see big volume on breakouts. We want to see low volume on pullbacks, right? So as it's pulling back, we want to see low volume, and and let's just talk about that for a second before we move on. So here we go. Here is Cloudflare, and it broke out here, right? Actually didn't quite break out here. Broke out here. Volume was a little bit higher. By the way, this is a 20 SMA. We're going to go into moving averages in a second. On the volume. So basically, this tells me the average of the last 20 days volume amount, how many shares were traded. And then I could um, compare the bar against that and see if volume is high or low based on 20 days of data. Some people use 50, whatever you want to use. So you see here, the breakout volume was up, but nothing crazy. The next day, it went really, really, really high over here. Beautiful bar. That's not Aunt Millie buying. That is some serious, serious buying. So, a couple of days of really high volume and then the pullback. And like I said, on the pullback, we want to see a decreasing volume. Boom. Right? That's what we want to see. So it's pulling back into its moving averages and volume is drying up, right? We have a big move, big move here on volume, and then the sideways movement. And guess what? Boom. And even within this, the red bars are minuscule, right? Even here, we have this sideways movement, maybe an inverse head and shoulder forming here, who knows? But again, we have low volume compared to the 20-day SMA, right? So volume is drying up while it consolidates. That is a bullish look to this chart. And so that's kind of how I use volume. I'm also looking for accumulation distribution. So if you look here, this green bar up was much higher than this red bar the day before that was down. So this I would consider an accumulation bar. These were all below average. And then you have a big green bar accumulation. Big accumulation bar here, big accumulation bar here. Obviously in here, all accumulation here. So that's kind of, I'm looking for accumulation and distribution. Whereas if you look over here, this is more of distribution right here, right? Distribution right here. So this is a place where I don't, it's not a favorable volume profile in this area. But see how it switched here and look at the run. And when you do the move, even if you bought here, it's up 71%. No big deal, right? So that is volume. The only last thing I'm going to say is sometimes after a big move, if you see a huge volume amount, something that looks like this potentially, you do have to be worried for what they call blow off top, which is the end of a move. So that's just something to be to consider. But it's and that's why we have our rules on risk management, right? Just to make sure that doesn't happen to us, that we don't get caught on a blow off top and then it starts to a downward cycle. I think that was what I had on volume, accumulation distribution, 20-day SMA. Again, I'm also using a 20-day, even though technically this is accumulation day and this isn't because it's not bigger than this day, but it's still a great, nice green bar, right? So I still kind of look at, this is not considered accumulation, I guess, by the strictest sense of the word, because it's lower than this bar, but it's still a big green bar. So I still consider it accumulation for my purposes. Okay. So next up is going to be moving averages. And we have two types of moving averages, right? We have a simple moving average and we have an exponential moving average. So a simple moving average is basically if you use, we'll call it the 50-day moving average, right? You're using the 50-day moving average and it takes the last 15 trading days of closing prices, divides that by 50, and that's the average. On the next day after that, the last day drops off, the new closing price goes in, it recalculates, that's the new moving average, and it plots it. Boom. Very similar to how a line chart looks, right? Just on closing price, and it connects the dots, every day advancing by one more day and dropping off the last day. Popular ones are the 20-day moving average, the 50-day moving average, the 200-day moving average, and they all work. Then there's the exponential moving average, right? And so it's the same as the simple moving average, except it gives more weight to the more recent prices. And there's a formula for it. I don't know what it is. I don't really care what it is, but there's a formula for it. So basically, it's weighted more heavily for the more recent price movement, which makes that moving average maybe a little bit more responsive to to price, which is something that I do like. Okay. And if you look at let's go and just put like a 50-day on here, and I'm gonna leave the 65-day. Boom. And you can see that they are similar, right? So the orange is the 65-day and the blue is the 50-day. And it's similar. And they're both gonna work. And so you have to decide what you like better. But I use the 65-day exponential. That's the 50-day simple. Nothing wrong with that. But it's all what you're used to. Now I'm going to get into why I choose the time frames on my moving averages that I do. Let's get the 50 off of here, and then keep going. All right. So that's the difference between simple moving average and exponential. Exponential is weighted more heavily for the more recent prices, making it a little bit more responsive to price movements. So 23-day EMA, or daily exponential moving average, or the 65-day EMA, right? So 23 days is roughly 1 month of trading. So that is one of the reasons why I like to use the 23-day on my charts. Roughly 1 month of trading. Here's the average price weighted a little more heavily with the more recent price movement. The 65-day EMA, that's roughly 1/4 of trading, right? So one rolling quarter of trading. And so you get that kind of movement in this average also. The other thing that I do like about using these two, besides the monthly and the quarterly time frames that they represent, is that it gives you a little bit of room away from the crowd. If everyone's huddled into the 20 and the 50, and some big institution is taking out stops, and they know that people put stops at the 50-day simple moving average. Well, I'm at the 65-day EMA, and they're not hunting for those stops. So I may not be stopped out. And EXAS was a good example of that trade I'm currently in also. And you can see I have let it ride shares. So I'm using my 65-day EMA. It came back down. If I had the 50, it would have taken it out, I believe. Yep. The 50 would have been taken out. Whereas the 65-day, it really didn't even touch it. And it bounced higher, and it's at all-time highs, making it a wonderful little flag right here. So so there's a psychological piece on that too, that it takes me away from the herd or the crowd, and I think there's an advantage in that also. So closing up, trend. Let's talk about trend. So moving averages really for me represent the trend, and so yes, I use them for stops, but really I'm looking to see the direction of the moving averages, especially when I'm looking to start positions where they have to be, up and to the right? All the moving averages, and they have to be aligned correctly. And sometimes, if it's real messy and there's been a lot of choppiness in the markets, what I like to do is I will go ahead and I will take off everything, take off everything, um, including price, and put it on a ton of moving averages, all different time frames, and I'll just look at them. And then I'll ask myself, what's the trend? So I can see here that there's some consolidation or something like that going on the short term, but longer term, the trend is nice and high. So this is nothing to be overly concerned about. This would be normal price action. You see it went through a consolidation period back here, a little consolidation short term back here, and now it's a little consolidation short term back here. Everything is, for the most part, bullishly aligned, especially on the longer term time frames, and looks like that's trying to start to move higher. So I do like to use multiple moving averages. Some people call these ribbons. I've seen people use them as ribbons. But I like to see multiple moving averages and see what does it tell me, because this clears out all the clutter, all the noise, and I'm just looking for trend. So that's another way I like to use moving averages. And let's get off all of them except for the ones I actually like. Which are those? All right. And the last thing I'm going to say is, keep it simple, stupid, right? K.I.S.S. I try to keep my charts as simple as possible, because if I put on RSI and I put on MACD and I put on stochastics and all these other indicators, really I'm losing. Those are all secondary. I'm losing the primary indicator, which is price. Everything else is supplemental to price, secondary to price. So that's my goal, is to keep my charts as clean as possible, with as little as possible, right? And let the essence of the chart speak to me. I'm not formally trained, as you all know. I am just the guy next door, trying to figure this out and make good risk reward trades in the stock market. So again, this is not advice; this is just the way that I found it works for me. And one, I'm going to close with a public service announcement. Please, please, please do not make your charts look like this. This is crazy. Anyway, hope you all have a great day. Hope this helped you guys and gals out there. Take care. Leave me some comments below. Like and subscribe to my channel. I think right now I'm supposed to say smash the like button or something like that, right? Smash the subscribe button. Anyway, y'all have a great day. Talk to you later. Bye.